Welcome back to the deep dive. It is great to have you with us. Today, I want you to close your eyes for a second, unless you're driving, in which case, please keep them open, and imagine a digital ticker tape.
You know the one.
Exactly. It's flowing through a modern cityscape, maybe Times Square, Dalal Street, bright red and green numbers scrolling endlessly across the side of a building. It represents the market. We look at it every single day. We say things like, oh, the market is up, or the Nifty crashed today, or the Sensex is at an all-time high. But here's the question that has been bugging me, and it is the reason we are gathered here today. What does that number actually represent?
That's a great question.
Is it the whole economy? Is it just a specific sector? Or is it just some complex mathematical abstraction that we have all collectively agreed to worship?
It is a fascinating place to start because, in many ways, the index is the most visible part of the financial world, yet the mechanics of it, the actual gears and levers turning behind that screen, are often the least understood.
Right.
People tend to treat the index like a thermometer. They think it's just a simple tool that tells you the temperature outside. Is it hot? Is it cold? But that's a dangerous oversimplification.
Okay, so it's not just a simple measurement.
Not at all. An index is actually a lot more like an engine. It has moving parts, it consumes fuel, it requires maintenance. And if it isn't built correctly or if the design is flawed, it can overheat or give you completely false readings about what the car or the economy is actually doing.
That is a great analogy, and that is exactly our mission today. We are taking a stack of research, specifically looking at Chapter 2 of the NISM Equity Derivative Certification material, and we are going to tear it apart.
Get right under the hood.
We're going to figure out how these indices are built, why the math matters, and honestly, why you should care even if you aren't a math whiz. We need to understand the architecture because ultimately our money lives inside that architecture.
And the timing for this deep dive is actually perfect. Since it is February 1st, 2026, right now, we are in the middle of a massive shift in how indices are regulated in India.
That's the SEBI stuff.
Exactly. We have the new SEBI rules from late 2025 regarding weight caps and eligibility that are being implemented as we speak. We are literally watching the Bank Nifty undergo a surgical procedure right now. So understanding the math under the hood isn't just academic anymore. It determines whether you are actually diversifying your risk or if you are just exposing yourself to the whims of a few massive companies.
Okay, let's unpack this. Before we get into the heavy regulation stuff, which I know is going to be the main course, let's start with the appetizer, the basics.
Let's do it.
What actually is an index? When I see Nifty 50 or Sensex at 25,000 or 80,000, what am I looking at? Is it just an average of stock prices? Like, do they just add up 50 stock prices and divide by 50?
It would be a lot simpler if they did, but no, not quite. The source material defines it as a statistical indicator. I know that sounds dry, so let's think of it as a portfolio.
A basket of stocks?
A basket of stocks, exactly. A collection of securities that is meant to represent a market or a specific portion of a market. But here is the key concept that trips people up. The number itself. Say, the Nifty is at 25,000. Doesn't mean anything in isolation.
So 25,000 isn't a price?
No. It doesn't mean the companies are worth 25,000 rupees. It is expressed in terms of change from a base value.
Right, so it is relative. But relative to what?
Relative to a specific moment in time. Every index has a birthday, or a base date. For the S&P CNX Nifty, the base period was November 3, 1995. On that day, they arbitrarily said, okay, the value of this basket is 1,000.
Just picked a number.
They just picked a nice round number. For the Sensex, the base year was 1978-79, and the base value was 100. Every number you see today is just a calculation of percentage growth from that starting point.
So if the Sensex is at 100,000 today, just as a round number, and the base was 100, that essentially tells us the basket has grown 1,000 times since 1979.
Roughly speaking, yes. The significance isn't the raw number, it is the movement. It serves three main roles. First, it's a barometer for the economy. Is the general sentiment optimistic or pessimistic?
The mood of the market.
Exactly, the mood. Second, it's a benchmark. This is huge for the industry. If you pay a mutual fund manager a 2% fee, you need to know if they are actually smart or just lucky.
Right. Are they earning that fee?
You compare their return to the index. If the index did 15% and they did 10%, they failed. They underperformed.
And the third role?
The third role is crucial for our discussion on derivatives. It's an underlying asset.
That is the big one for traders, right? The index isn't just a scoreboard. It becomes the product itself. You can trade the scoreboard.
Exactly. You can buy the Nifty, sell the Nifty, hedge with the Nifty. And because you can trade the scoreboard, the rules of how the score is calculated become a matter of life and death for your portfolio. If the rules are biased, the game is rigged.
That leads us perfectly into the how. How do we cook this stew? I assumed, maybe naively, that if you have an index of 50 companies, they all just contribute equally, like it's a democracy. But looking at the source material, that is definitely not the case.
Not even close.
There are different methodologies.
That's right. There are 4 specific ways to build this stew, as you call it, and they yield completely different flavors. The most common one, and the one most people interact with without realizing it, is the market capitalization weighted index.
Okay, market cap. We hear this term constantly. Large cap, mid cap. But let's verify we know what it means. Break down the math for us.
It is relatively straightforward, but the implications are profound. A company's market capitalization is the total value of all its shares. You take the current price of the stock and multiply it by the total shares outstanding.
Simple enough. Price times number of shares.
Right. So, math time. If company ABC has a stock price of Rs 120 and they have issued 5 crore shares total, what is the company worth?
Let's see. 120 times 5 crore, that would be RS 600 crore.
Correct. That is their market cap. Now, in a market cap weighted index, a company's influence on the index is proportional to that value. The bigger the company, the more weight it has.
So if I'm a massive conglomerate worth 10 lakh quos and my stock moves 1%, the index moves a lot.
A lot.
But if I'm a tiny company at the bottom of the list worth 10,000 crores, my stock could double and the index might barely blink.
That is exactly right. It's a system where size equals power. The source gives a specific calculation example where they list stocks AZ, BY, CX, DW, and EU. They show how the index moves from a base of 100 to 226.06, purely based on the change in total market cap of that basket.
So the index value is just the new total market cap divided by the old total market cap times the old index value.
That's the core of it. But think about the strategy implication here. This methodology is basically a momentum strategy.
How so?
Think about it. If a stock's price goes up, what happens to its market cap?
It goes up too.
Right. And if its market cap goes up, its weight in the index increases. So index funds are forced to buy more of it to stay in line with the index, which drives the price up further. It rewards the winners.
It feels like a survival of the fittest system. The winners get more influence, which makes them bigger winners.
It's a positive feedback loop.
But doesn't that create bubbles? If a stock gets overvalued, the index just doubles down on it.
It absolutely can, and that is the primary criticism of market cap weighting. It's what happened during the dot-com bubble. Tech stocks became a huge part of the S&P 500 just before they crashed, which made the crash even worse.
Ouch.
But despite that flaw, it is the standard because it reflects the economy's actual distribution of value. However, there is a nuance here that changed the game in India a few years back. The Nifty and Sensex used to use total market cap, but now they use something called free float market capitalization.
Free float. I always think of a root beer float when I hear that, which sounds delicious, but I have a feeling it's about share availability, not ice cream.
No ice cream involved, unfortunately. It is about the real market versus the theoretical market.
Okay, explain that.
Think about a giant PSU, a public sector undertaking, like Coal India, or a family-run giant like TCS. Let's say a company has 100 shares total, but the government owns 80 of them and will never sell them.
They're locked up.
They're locked up. Or the founding family owns 75% and has them in a trust for the next generation.
Right. So those shares exist on paper, but I can't buy them. They aren't actually in the market.
Exactly. So if we build an index based on total market cap, we are giving that company a huge weight based on shares that aren't actually trading. It distorts the picture.
How does it distort it?
It tells the fund manager, hey, this company's huge, you need to own a lot of it. But the fund manager says, I can't. There are no shares available to buy. It creates a massive liquidity problem.
Ah, I see. So free float effectively excludes the shares held by the bosses, the government, and the strategic investors, the ones that aren't for sale.
Correct. It only counts the shares available for trading by the public. This is the current standard for Sensex, Nifty, and the SX40. It ensures the index reflects the investable opportunity set. It's a much fairer, much more practical way to represent what a trader can actually do.
That makes sense. It feels fairer. But then the source material mentions this third type, the price-weighted index. And honestly, this one broke my brain a little bit. It seems archaic.
It is the anomaly. It is the dinosaur in the room. In a price-weighted index, The stock with the highest price per share gets the most weight.
Wait, just the price? Not the total value of the company? So the number of shares doesn't matter at
It's
all.
just the stock price.
Yeah.
The number of shares is completely irrelevant.
Okay, let me construct a scenario to show how weird this is. Let's say I have a tiny, tiny company. Let's call it Bob's Burgers. But I only issued 10 shares, and they trade at, say, Rs 50,000 each.
Okay, a very expensive burger joint.
A very premium burger joint. And then I have Reliance Industries, a massive titan of industry trading at Rs 2,500. In a price-weighted index, Bob's Burgers is more important than Reliance.
Significantly more important. In fact, Bob's Burgers would be the driver of the index. If your stock moves 5%, it drags the index around by the nose.
And if Reliance moves 5%,
It's a rounding error, because 5% of 2,500 is a much smaller number in absolute terms than 5% of 50,000. It's the absolute price change that matters.
that sounds objectively flawed. Does anyone actually use this? I mean, for real.
Surprisingly, yes. Two of the most famous indices in the world use this, the Dow Jones Industrial Average in the US and the Nikkei 225 in Japan.
Why? I don't get it. Is there a logic I'm missing?
It's mostly history. When Charles Dow created the index in the late 1800s, they didn't have computers. Calculating market cap for 30 companies every hour was impossible.
Right, no spreadsheets.
But adding up 30 stock prices and dividing by 30, you can do that on a napkin, it was a calculation of convenience that became a tradition. The source material walks through the math. Sum of prices divided by a divisor. But here is where it gets really weird. What happens if a stock splits?
Oh, right. If a stock is trading at Rs 10,000 and does a 10-for-1 split, it is now trading at Rs 1,000.
But the value of the company hasn't changed at all.
No, you just have 10 Rs allows 1,000 notes instead of one Rs 10,000 note. The total value is the same.
Exactly. The company is the same size. But in a price-weighted index, its weight just dropped by 90%. It loses its influence instantly.
That's a massive distortion.
Huge. The index maintainers have to adjust the divisor mathematically to prevent the index from crashing, but the weight of that company is permanently reduced just because of a cosmetic accounting change.
That is wild. It really shows how arbitrary some of these benchmarks can be. Okay, so we have the big guy wins with a market cap.
The tradable guy wins with free float.
And the expensive guy wins with price weighted. What's the fourth one?
The fourth one is the equal weighted index. This is democracy in action.
One person, one vote. Or one stock, one vote in this case.
Exactly. If you have an index with 50 stocks, every single stock gets a 2% weight.
Yeah.
It doesn't matter if it's the largest company in the country or the 50th largest. They all impact the index equally.
That sounds nice in theory. It prevents that concentration risk where one company is the whole market. I know recently people were worried that a company like NVIDIA was practically the whole S&P 500 growth story.
Right.
An equal-weighted index would solve that. But I imagine it's a nightmare to manage.
You hit the nail on the head. It is a maintenance headache. Let's play this out. You start with stock A and stock B, both at 50% weight.
Okay.
Stock A has a great quarter and its price doubles. Stock B has a bad one and its price drops by half.
So the portfolio is now way overweight stock A.
Exactly. Now, stock A represents a huge chunk of your portfolio's value, way more than 50%, and stock B is tiny. To get back to equal weight, what does the fund manager have to do?
They have to sell some of stock A and buy more of stock B.
Exactly. They are forced to sell the winner and buy the loser.
Which is, well, that's buy low, sell high. That sounds like a good strategy.
It is a value investing strategy built right into the math. And historically, equal-weighted indices often outperform over very long periods because of this automatic rebalancing.
But there has to be a catch.
There is.
Yeah.
The transaction costs.
Yeah.
You are constantly churning the portfolio. You're paying brokerage fees, paying taxes, and you're fighting the market's momentum. In a strong bull run led by big companies, equal-weighted indices can lag behind badly because they keep selling the winners too early.
So no free lunch. Every methodology has a trade-off. It's about choosing your bias.
Precisely.
Okay, let's pivot. We know how they are built, but the source material spends a lot of time on what makes a good index. It lists attributes like market behavior and independent computation, but then it brings up a term that I have heard traders whisper with a mix of fear and respect: impact cost.
Ah, yes. Impact cost. This is where we separate the amateurs from the pros. If you take one thing away from today's technical section, let it be this.
Okay, I'm listening.
We often talk about liquidity. Usually people think liquidity means volume. Oh, this stock traded 1 million shares today. It's super liquid. But volume is just activity. Impact cost measures the quality of that liquidity.
Define that for us. What is the difference?
Think of it this way. Volume tells you how many shares changed hands. Impact costs tells you how much you suffered to get your trade done.
Suffered.
Yes. It is the cost of executing a transaction due to the lack of liquidity. Specifically, it measures how much the price moves against you when you try to put through a large order.
Okay, I want to slow down here because the source material has a very specific numerical scenario about an order book, and I think we need to visualize it.
Let's walk through it.
Imagine I am a fund manager and I need to buy shares. I open the order book on my screen. What do I see?
You see two lists side by side.
Hmm.
On the left, you have the buyers, the bids. They're saying, I will buy X shares at this price. On the right, you have the sellers, the asks. They are saying, I will sell Y shares at this price.
Got it. Bigs and asks.
The source gives us this setup. The best buy order is for 1,000 shares at a price of 9.8,
Okay.
and the best sell order is for 1,000 shares at 9.90.
Okay, stop there. So the buyers want to pay 9.80, sellers want to get 9.90. The real price or the ideal price is somewhere in the middle of that spread.
Exactly. We call that the ideal price. It's the average of the best bid and best ask. So 9.80 plus 9.02 equals 9.85. In a frictionless magical world, if you wanted to buy, you would pay 9.85.
But we don't live in a magical world. We live in a world where I have to pay what the seller is asking.
Precisely. Now here is the scenario. You're a fund manager and you need to buy 1,500 shares right now.
Okay, 1,500 shares.
You look at the sell side. The first guy in the queue is selling 1,000 shares at 9.90. You say, done. You take all 1,000 of his shares.
Great, so I've got 1,000 shares at 9.90, but I'm still short. I need 500 more.
Right. The 9.90 guy is sold out. His order is gone. You have to look at the next guy up the ladder. The order book says the next seller has 1,500 shares available, but he wants 10.00.
Ouch, so I cleared out the cheap stuff, and now I have to pay a premium for the rest. My own order moved the market against me.
Yes. This is the definition of impact. Your demand just pushed the price up, so you have to buy your remaining 500 shares at 10.0.
Okay, so I got the trade done, but at what cost?
Let's calculate your actual cost. You paid 1,000 shares, 9.90, plus 500 shares, 10.00. Divide that total cost by the 1,500 total shares you bought. Your average cost per share is 9.9333.
Okay, I'm with you. Ideal price, the theoretical midpoint, was 9.85. The actual price I paid was 9.9333. The difference is about 0.08.
Correct. And if we express that difference as a percentage of the ideal price, that is the impact cost. So 9.9333, 9.85 divided by 9.85, then multiplied by 100. The result is 0.84%.
0.84%. Now, playing devil's advocate, that sounds tiny. Less than 1%. Why does the Nifty Committee care so much about 0.84%?
It sounds small on a single Rs10 stock, but imagine you're an index fund managing R10,000 crores. Every time you rebalance your portfolio or every time you get a new inflow of cash from investors, you have to buy these stocks in huge quantities.
Right.
If you are losing 0.84% just to enter the trade before the stock even moves, that is a guaranteed loss. It's like a hidden tax. It eats your returns alive over time. It creates a tracking error, meaning your fund will always perform worse than the index it is supposed to be copying.
So a stock's inclusion in the Nifty isn't just about its size or its industry. It has to be able to handle massive trades without the price getting knocked around.
That is the crucial insight. A good index isn't just a list of good companies, it's a list of tradable companies. If you put an illiquid stock in the Nifty, you break the functionality of the Nifty for everyone else.
So who decides this list? Who are the gatekeepers that measure this stuff?
It is usually specialized agencies. For the BSE, it is Asia Index, PVT, LTD. For the NSE, it is NSE Indices Limited. They are the ones who have to balance two opposing forces all the time. Diversification versus liquidity.
Okay, explain that trade-off.
You want to be diversified, right? You want to represent the whole economy.
Oh.
But the more stocks you add to get more diversified, the further down the quality list you go.
You start adding less liquid companies.
Exactly. The source mentions diminishing returns on diversification. I found this really counterintuitive when I first learned it. I always thought, the more stocks, the safer. Why stop at 50? Why not Nifty 5,000?
Yeah, that seems logical.
But it's a classic statistical reality. The data shows that going from 1 stock to 10 stocks reduces your risk massively. You eliminate the risk that one CEO goes crazy or one factory burns down. That's unsystematic risk.
Okay.
Going from 10 to 20 helps a lot too. But once you get past 30 or 50 stocks, the marginal benefit of adding another stock is almost zero. The risk reduction curve flattens out completely.
So a Nifty 500 isn't necessarily much safer than a Nifty 50 in terms of systematic market risk.
Not significantly, but the cost goes way up. Because stock number 499 is going to be way less liquid than stock number 5. So if you build a Nifty 5000, you're adding tons of impact costs for almost zero benefit and risk reduction.
So 30/50 is the sweet spot.
It's the sweet spot. That explains why major global benchmarks, Dow 30, Eurostoxx 50, Nifty 50, usually hover around that range. It is an optimization problem.
That makes perfect sense. Now, once they build it, they can't just walk away. They have to maintain it. The source distinguishes between maintenance and revision. What's the difference?
Maintenance is the boring but essential accounting work. It handles what we call corporate actions.
Like stock splits or dividends.
Exactly. Let's say a company pays a huge dividend. Its stock price will drop by the dividend amount on the ex-dividend date. If we do nothing, the index value would fall.
Which isn't fair because value wasn't destroyed, it was just paid out to shareholders.
Right, so maintenance adjusts the index math, usually the divisor, to keep the index value comparable across time, despite these accounting changes. It's about continuity.
And revision, that sounds more dramatic.
Revision is the exciting part. That is when the index committee meets, usually semi-annually, and decides the roster. They look at the data. They say, Company X, your liquidity has dried up, or your market cap has fallen below the threshold, you are out.
Yeah.
Company Y, you're the new hotness, you've grown, your impact cost is low, you are in.
It is like relegation and promotion in the Premier League.
Exactly. It ensures the index remains vibrant and reflects the current economy, not the economy of 1995. And there is one niche concept mentioned in the source called a surrogate or pseudo-index.
Yeah, that sounded like a stunt double in a movie. What is a surrogate
The
index?
stunt double is a great description. Suppose a primary index, say on the NSE, fails a review. Maybe it's not liquid enough temporarily or there are some regulatory issues. But there is another index, maybe on the BSE, that is highly correlated.
So they move in almost the exact same way.
The source sets the bar high. If the correlation is over 0.90 and they share at least 50% of the same stocks, the exchange can use that surrogate index to keep derivatives trading alive while they fix the primary one.
Briefly, for those who skip statistics, class correlation of 0.90 means what?
Think of it like two dancers moving in sync. If one moves right, the other moves right. A correlation of 1.0 means they are identical, perfect mirror images. 0.90 means they are almost perfectly in sync. So if the main index breaks a leg, you can film the stunt double, and the audience, which is the traders, barely notices the difference.
Got it. Okay, I want to shift gears to what I think is the most urgent part of this document. We are recording this for listeners in February 2026.
Right.
The source material highlights the SEBI circular from October 30th, 2025. This is changing the rules of the game right now. This isn't history, this is current events.
This is huge. For years, we had a problem in India with concentration risk in our derivatives. We had indices where one or two banks or one IT giant made up 30, 35, sometimes even 40% of the entire index.
So you think you're buying a diversified basket of banks?
But you're really just making a massive bet on HDFC Bank. At times, its weight was so massive that if it had a bad earnings report, the entire bank, Nifty or Nifty, would crash, even if the other 49 companies were doing just fine.
So the index wasn't really a basket, it was just Reliance plus some other guys.
Precisely.
Yeah.
And that creates systemic risk for the whole ecosystem. If that one stock is manipulated or have a fat finger trade, the whole derivatives market blows up.
Right.
So SEBI stepped in. The circular mandates strict caps for non-benchmark indices that are used for derivatives.
Let's run through the rules. What are the magic numbers that every trader needs to know right now?
There are three main constraints introduced by this new regulation, and they are critical. Constraint 1. An index must have a minimum of 14 constituents.
So no more tiny 5-stock indices. You need breadth.
Right. Constraint 2. No single stock can have more than 20% weight. This is the big one. This is the hard ceiling.
And the third?
Constraint 3. The top 3 stocks combined cannot exceed 45% weight. So you can't have 3 stocks at 15% each, for example.
Wow. 20% cap. That is a hard ceiling. HDFC Bank used to be way above that in the bank indices, wasn't it?
It was. And since we are in February 2026, we are watching the implementation of this in real time. The source specifically mentions the timeline for compliance.
So how's that playing out?
For Bank X, BSE, and FNIFTY, NSE, they had to implement this by December 31st, 2025. So that is done. Those indices are now capped. But for Bank Nifty, NSE, the big daddy of derivatives, they're in the middle of a 4-tranche adjustment that ends on March 31st, 2026.
4-trotted? That sounds like a surgical procedure. Why 4 tranches? Why not just rip the Band-Aid off and get it over with?
Think about the mechanics. If HDFC Bank is, say, 28% of the index today, and the rule says you need to get it down to 20% tomorrow,
Oh.
Every index fund and ETF tracking Bank Nifty would have to sell millions and millions of shares of HDFC Bank simultaneously at 9:15 a.m.
It would cause a market crash in that single stock.
It would be a disaster. It
Yeah.
would create panic, so they have to smooth it out.
So how does the tranche math work? How do they do it gently?
The source has a great illustration. Let's walk through it. Imagine a stock has a 28% weight. The target is 20%.
Okay, so the excess is 8%.
Right. They don't cut that 8% all at once. They divide the problem by 4. So the plan is to reduce the weight by roughly 2% each month for 4 months.
Okay, so month 1, at the end of December, they cap it at 26%.
Mhm.
Month 2, end of January, they cap it at 24%. Month 3 at 22, and finally they get to 20 by the end of March.
That's the plan. But here is where it gets tricky and where the opportunity lies for savvy traders. The adjustment is dynamic.
What do you mean by dynamic?
Stock prices move during the month. Suppose in month 1, the index funds are forced to sell a bit to get the weight down to 26%, but then during January, the stock price of that bank crashes naturally by 10% because of bad earnings.
Okay.
Its weight in the index drops automatically just because its market cap shrank. So when the index committee looks at it at the end of January for the month 2 adjustment, maybe the weight is already down to 23% naturally.
Ah, so they don't need to force a 2% cut anymore. The market did some of the work for them.
Exactly. Maybe they only need a small tweak, or maybe no selling at all. The forced selling pressure changes every month based on how the stock performed.
I see. So it creates a fascinating game of cat and mouse. Traders are trying to predict, will the index funds be forced to sell big this month, or did the natural price drop do the work for them?
That's the game right now. Since we are in February 2026, we have 2 tranches left, the end of February and the end of March. We are going to see volatility on those rebalancing dates as the funds realign with the new caps.
That is incredibly actionable for anyone trading Bank Nifty right now. Watch those rebalancing dates very closely. Now, zooming out a bit, we have built the index, we have regulated it, but what do we actually do with it? The source lists applications. It's not just for looking at on a screen.
No, it is a tool. It's a Swiss Army knife for investors. There are 3 primary applications. First, and most simply, index funds.
Passive investing. Just buy the whole basket.
Exactly. But the source notes something important called tracking error.
We touched on this with impact cost. It's the difference between the fund's return and the actual index return. Is it always negative? Does the fund always do a little bit worse?
Almost always. Because the index is a mathematical, theoretical paper portfolio. It pays no brokerage fees. It pays no taxes. It has 0 impact cost. It doesn't have to hold cap.
That's perfect.
It's perfect. The index fund is real life. It has management fees. It has cash drag because it has to keep some money in the bank for redemptions.
Yeah.
So the fund will always lag the index slightly. A lower tracking error means a better, more efficient fund manager.
Got it. Second application.
Index derivatives. This is the whole focus of this certification, futures and options on the index. And the main use case here is hedging against systematic risk.
Okay, can we define systematic risk? I know there's unsystematic and systematic.
Sure, unsystematic risk is risk that's specific to a single company or industry. The CEO of Infosys quits. That hurts Infosys, maybe the IT sector. You can solve this by diversifying, by also buying TCS and Wipro and a bank and a pharma company.
You spread the risk out.
Exactly. But systematic risk is the market. It's the big stuff. The COVID crash, the 2008 financial crisis, a war, a major interest rate hike by the central bank. These things hurt every stock. Diversification doesn't help you here because everything falls together.
So how do index derivatives help with that?
You can't hedge a market crash by buying put options on 50 different stocks. The transaction costs would be insane, and the liquidity in many of those options would be a nightmare.
It's impractical.
Completely. Instead, you buy one put option on the Nifty index because the Nifty represents the whole market. It has a beta of 1 by definition. If the market crashes, your Nifty put option makes money, offsetting the losses in your stock portfolio. It is the only efficient way to insure against a market-wide disaster.
That makes the index a massive insurance product for the entire financial system. And the third application.
ETFs, or exchange-traded funds, these are like index funds. They track the index, but they trade on the exchange, like a single stock.
So it's the best of both worlds.
In many ways, yes. The source calls this basket trading. With a traditional mutual fund, you can only buy or sell at the end of the day, at that day's closing price. With an ETF, you can buy the whole Nifty at 10:00 a.m. and sell it at 10:15 a.m. It offers liquidity and intraday flexibility that mutual funds just can't.
It really democratized access to the market. You can buy the whole economy in one click.
That's a good way to put it.
Before we wrap up, I have to ask about the product success framework PSF mentioned near the end of the chapter. It sounds like a corporate performance review. Do indices actually get fired?
They absolutely do.
Yeah.
Or rather, the derivatives on them get fired. Creating an index derivative is expensive for an exchange. You have to market it, maintain the data, regulate it. If nobody trades it, it's a zombie product just taking up space.
So they have standards.
SEBI and the exchanges have a strict framework. To survive, a derivative index needs to meet several criteria consistently. 1. Trading members. You need at least 15% of all trading members active in it, or 20 members, whichever is lower. You can't just have two guys trading it back and forth to create fake volume.
Okay, broad participation. What else?
2. Trading days. It must trade on at least 75% of the available days. It can't be dormant for weeks at a time. 3. Turnover. The average daily turnover must be over Rs 10 crore.
And 4.
Open interest. The average daily open interest, the number of contracts outstanding, must be over Rs 4 crore.
So if you don't hit those numbers, say you launch the Deep Dive Podcast Index and nobody buys the futures.
You are out. The exchange will stop issuing new contracts, the existing ones will run to expiry, and then the product is delisted. It's a ruthless ecosystem. Survival of the fittest applies to the products as much as it does to the companies.
And the same applies to individual stocks, right? If a stock stops being liquid, it gets kicked out of the futures and options segment.
Yes. For single stock derivatives, the bar is even higher, turnover of over 75 crores, and open interest of over 500 crores. If a stock falls below that for 3 consecutive months, it loses its derivative status. That's why you see the list of F&O stocks changing every year.
This has been a massive download. We have gone from the simple definition of an index to the complex math of how it is calculated, the flaws of price weighting, the hidden costs of liquidity through impact cost, the surgical tranche regulations happening in our market right now in 2026, and how these products ultimately live or die.
It's a lot to cover.
So bringing it all home, what does this all mean for our listener? What's the big takeaway?
I think that, so what is this? The market isn't a monolith. It isn't some force of nature or a god. It is a man-made machine. It is a carefully curated, mathematically constructed list with its own biases and rules. So when you see the nifty move, you now have the tools to ask, is it moving because of broad economic growth? Or is it moving because it is market cap weighted and momentum is just driving the top 3 stocks to the moon? And with the new regulations, the 20% cap, we are entering a new era. The market is being forced to diversify. We are breaking the dominance of the mega caps.
Which brings us to our final provocative thought for the day.
Let's hear it.
We are moving toward these capped indices. We are telling the market, you cannot have a winner that is too big. Are we making the market safer? Yes, probably. We're reducing concentration risk.
Big goal.
But are we also artificially suppressing the winners? If HDFC Bank or Reliance deserves to be 30% of the economy because they are that innovative, that efficient, that good, are we punishing success by capping them at 20%? It is a fundamental debate between market purity, where you let the winner take all, and market safety, where you enforce diversification at all costs.
A very interesting thought.
And as we watch the Bank Nifty adjust over the next month, we are going to see exactly how that tension plays out in real time.
It is the classic tension of financial regulation. How much intervention is too much? And as always, the answer lies in the details, in the denominator of the calculation.
Thank you for guiding us through the math, the madness, and the mechanism of the index.
My pleasure. It was a great discussion.
And to you, the listener, next time you see that ticker tape scrolling, remember, it's not just a number. It's a weighted, adjusted, regulated, and filtered version of reality. Keep diving deep. We will see you on the next one.